So by the end of this video, you'll be able to understand how to interpret Forex fundamental analysis properly, and I'm going to divide this video into 3 main sections which you must pay attention to. The last one, I'm going to share with you a shortcut on how to use fundamental analysis to make more profits in Forex trading, okay? First thing first, I'm going to share with you what is FA and why do you use FA? Because this is what institutional Forex traders look at. And I'm going to share with you later on, the second part, 3 key components of Forex fundamental analysis that you must learn. Then the end, I'm going to share with you a software, a very useful software for FA that can shortcut everything, make everything easier for you. If you think FA is complicated, this will solve your problem. Now, what is Forex fundamental analysis? Okay, now to put in simple terms, you gotta look at the political factors as well as economic factors. And if you're a value investor like me, invest in stocks long term, then you gotta look at the financial statements, meaning the financial factors. Okay, and why do you gotta study fundamental analysis? Because if you're a long-term trader, this is super important for you. And Forex institutional traders focus more on FA than what the typical retail focuses on, which is technical analysis. And most importantly, it helps you understand where the long-term trend is going to go, as well as institutional positioning. What are the big money doing? What are they looking at? What are they ignoring? And it's not just for long-term traders. Even if you're a day trader, FA is not super important for you, but you still gotta look at it, because when you're a day trader, it's better for you to trade when there's no significant high impact events. Because most retail traders, what do? They scout the NFP, the high impact events, and then they get into slippages problem, then they pay a high amount of cost in terms of spread and commission, and then they get requoted all the time because they are trading news all the time. So as a day trader, look at the economic calendar, the major events, and use that to determine when not to trade. Now, I've already done several fundamental analysis courses on my channel where I talk about almost all of the important economic indicators. So for this video, because it's not really a course, I'm just going to share with you the major economic indicators you should take note of. Now, understand that economic indicators, you shouldn't pay attention to everything, because some of them, they lag behind data, so you use it for a different purpose, and some of them, they react along with the data, coincident indicators, and then some of them give you clues as to what's going to happen in the future, meaning leading economic indicators. This is what you should focus on, but that doesn't mean that you should ignore this and this. Now, let's not be confused about all this for now, because I just want to share with you the main economic indicators. Okay, the stuff that most people talk about that you might not understand as a beginner yet. First one is GDP, gross domestic product. Basically, it measures the economic growth rate of a certain country, and hence it's going to affect the currency. How does it affect the currency? To put in simple terms, the stronger the GDP, then the stronger the currency. Okay, this means that the weaker the GDP, the weaker the currency. Now, the next one, inflation data, which is measured by CPI, PPI. I've already explained all this in my FA course on YouTube. Basically, it measures inflation. So, high inflation, what's going to happen? Because prices are rising, so central banks, they would come in to control the inflation so that things don't get out of control, like your bread is getting too expensive and all that. So they are going to raise interest rates, which causes the currency to go up. Why? When the country's currency has a high interest rate, Investors, traders like to seek high yield, so capital is going to flow into a country, and hence more demand for the currency, and hence the currency is going to go up. If you don't know the basics yet, increase in demand, increase in the value of the currency, increase in supply, decrease in the value of the currency. Now the next thing, this is what a lot of retail traders like to scalp. Try to avoid that, okay? Try to avoid that. You can use it for different purpose. Employment is measured by NFP, as well as you have unemployment data. Basically, this is common sense for you. When there's a strong labor market, a lot of people are having jobs and all that, people are having a good time, hence the currency is going to go up. And the other data, do you think I need a bigger whiteboard? I think I need a bigger whiteboard, because this one ain't gonna make it. Let me know if you want a bigger whiteboard, because I'm really thinking about upgrading to a bigger one. The next one is trade balance. And how does trade balance affect the currency? When there's a surplus, trade surplus, then it's going to cause the currency to go up. And when there's a trade deficit, it's going to cause the currency to weaken. Now. All of these that I've mentioned so far, trade balance, inflation, employment, data, GDP, all of these are not leading indicators. You cannot use it to predict. By the time the data, the number has been released, it's telling you what has already happened or what is happening. But one thing for sure, you can use inflation data to determine what central banks are going to do. So it's not entirely a lagging indicator. What are the leading indicators? I've already covered this in my other FA video. Go through it if you want to. Because I want to move on to the next one real quick, and that is central banks. Second component, okay? This is the second topic you gotta study when it comes to FA, central banks and interest rate. Now, there are people who write a whole book just talking about interest rates and central banks. I'm just gonna give you the basics for now. So central banks, the main one, you gotta pay attention to the Fed, ECB, Bank of England, Bank of Japan, who always like to keep interest rates super low. So basically, when you look at central bank meetings, they always talk about certain terms like, okay, hawkish. What does hawkish mean? It means that they have a plan to increase interest rate. And just now, I already shared with you how interest rates affect a currency. Alright, and when they talk about things like being dovish, it means that they have a tendency to want to cut rates, which is going to cause the currency to go down. So as a trader, you gotta look at certain things when it comes to central banks. Gotta keep up, okay? Gotta keep up with the Kardashians, as well as gotta keep up with the central banks FOMC meetings. Gotta keep up with ECB statements. By the way, Kim Kardashian is studying law, which is good. Gotta keep up with rate projections. To put in simple terms, when times are bad, when there's a recession, central banks would step in to decrease interest rate to stimulate the economy. And when there's a high inflation, high economic growth, central banks are going to come in and increase interest rate to cool down the economy. And the third topic you gotta study, geopolitical factors. Basically, global macro factors, okay? And this is what Ray Dalio, Paul Tudor Jones do every single day, because they run a global macro hedge fund, and it's one of the most profitable trading strategies that you can adopt. Now this one can be a separate topic, sentiment analysis, but I'm just gonna put it here. To put in simple terms, you probably already know this already. When a country's political situation, okay, it's very stable, reliable, the currency compared to a less stable country is going to go up relative to that unstable currency. So it means that if the situation in the country is chaotic. The political situation is chaotic, unpredictable. You don't know what the gov is going to do next. The currency is going to go down relative to the more stable country. And also for sentiment-wise, you can understand there's a difference between risk-on and risk-off currencies. Risk-on currencies basically are those currencies with relatively higher interest rates as compared to other currencies, and traders would see these currencies as something I want to buy when times are good. So for now, it is Australian dollar, Canadian dollar, as well as New Zealand dollar. So when times are good, these currencies are going to go up, okay? If you study finance, you come across these two terms, risk on, risk off. My professor keep on teaching me this until I dream about it every single night. Risk off currencies, meaning the safe haven currencies. So what are safe havens? Basically, are assets that people are going to buy during bad times. For example, bonds. USD is seen as a safe haven currency. Swiss franc is seen as a safe haven currency, as well as yen. And do you realize that these two, Swiss franc and yen, they have extremely low interest rates, negative interest rates. So if you do carry trading meaning you buy currencies with a high interest rate, with a low interest rate currency, you would have a carry trade, okay? That you can hold long term, that's gonna pay you interest regularly, just like dividend stocks. So your swaps are going to be positive. And also these are also known as commodity currencies because the majority of the exports are commodities. Canada, for example, it's highly correlated to oil prices. Now, I know even for this quick summary, it's a bit daunting for a lot of beginners, but here's a very quick way to analyze fundamental analysis. And I want to share with you this software. Shout out to trader Nick, who created this software with his team. Don't use this to predict the markets, okay? Always rely on your own research, but you can use it to increase the probability of your trades and to make your research more simple and straightforward and fast and efficient. So this one of the softwares that you can use, and it's called the Edge Finder. So basically, instead of going to various websites to compile and research about all the fundamental data, you can use this as a quick overview as to whether the currency or commodity is going up or down. So Nick's team actually compiled everything here together. You can see over this column over here is the sentiment analysis, sentiment data. All right, so there's a lot of different tools over here, but I'm gonna go through a few. Which I really like is the COT data. And if you don't know anything about COT, basically it gives you an idea of the positioning held by institutional traders. So you can see over here at this point in time, Swiss franc, the institutional traders, they are mostly short, more than they are long. And if you know how to read COT reports, you know how complicated it is and how dry it is. But this page over here just gives you an overall summary, okay? Then you can also come to this smart money indicator, which gives you a comparison between the institutional traders as well as retail traders, okay? And I'll move on to the economic heat maps, okay? So let's go to US, and you can see over here are the major economic data, all right? And their team updates the data regularly based on the latest releases, and they compile everything together for you over here, the percentage change and the impact on USD as well as stocks. And depending on the currency that you're trading, you can navigate through the various currencies over here. You have EU, pound, Japanese yen, Canadian dollar, okay, so on and so forth. And if you want to go deep into the specific economic indicator like GDP, they also have data for this. So it gives you a good summary over here. And visually, it's also very easy to determine as compared to economic calendars, okay? So you can go through these economic data. And one of the things that I really like is the risk on and risk off gauge. Just now I talked to you about risk on, risk off, right? If you still don't understand, you don't know whether are we in a risk on market, risk off market, this gives you an indication, okay? As you can see, as of now, we are more of in a risk off market, and hence the safe haven currencies, like I mentioned just now, are going to be more bullish, whereas the commodity currencies, the risk on currencies that I mentioned just now, are going to be more bearish. And right at the bottom here, it also gives you all the important sentiment indicators. For example, percentage change and VIX, which I've taught you before, put call ratio, percentage change, gold, which is also an important sentiment indicator, as well as S&P 500, the various bond yields. And if you are still not clear, you can double confirm using the fear, greed, risk gauge. And because we are in a risk off market, you can see there's a considerable amount of fear. And if you're a carry trader, a long-term trader, you can also go through the carry trade scanner, which is also very useful when you want to pair a high yield currency with a low yield currency. So currently Nick and his team, they are doing a 40% off sale to celebrate their 3rd anniversary since they've launched this software. So I'll put a link and promo code for the 40% off in the description below, as well as the pinned comment.